So, welcome back to my video series on valuing companies. Those of you who've seen my introductory video, 3 Ways to Value a Company, have been asking me, can I go a little bit further and take on 1 or 2 of the techniques that I illustrate very briefly in that video. So in response to those queries, here is my tour of 1 of the 3 techniques I introduced in that initial video. Now, a quick recap for those people who haven't seen the video and are scrabbling around wondering where it is. It's called 3 Ways to Value a Company. It's very basic, and in it I describe basically 2 approaches to valuing a company, and the second one splits into to give you the third method. So in that video I talk about a bottom-up approach. This is the objective here, by the way, is if you're a predator about to buy a company, you want to know what it's worth, how much should you pay. Obviously you want to pay as little as possible, but you've got to justify the price in some way. Sellers have to justify their price. As an investor, these can be useful reference techniques for looking at, am I buying a share at the right price level? And bottom up is what I'm going to cover today. Now, bottom up is basically what it sounds like. There is a way of saying, well, one way to approach valuing a company would presumably be to get hold of its balance sheet. That's the statement of net worth, if you like. Start there and maybe make a few tweaks to get to what I think the company's really worth on the open market. That's what I'll be covering in just a moment. But as a reminder, it's not the only way to go about it, okay? There are what I could loosely call top-down approaches to valuing companies. All right, that can be split, roughly speaking, into 2 types of techniques. There's using multiples and there's DCF. Now, traveling rather fast because I may well take on these in other videos, but essentially you can use things like P ratios and price to sales ratios to sort of extrapolate a value for a company that you're looking at. All right, and you can use a thing called discounted cash flow, which is quite a meaty topic, which may take on in another video if there are requests for that, and that is projecting future cash flows, bringing them back to today's money using a discount rate. All right, fairly hairy stuff. But what we're going to do today is take almost the simplest of those 3, 1, 2, 3. I'm going to call this the assets approach. So that's your 3 techniques: assets, multiples, and DCF. All right, going to focus over here and just ask the question, how would I go about that? All right. Well, I gave you a hint just now, and this is going to be a rough guide. I could say a lot more, but it just gives you a flavour of how this works. Okay. Now, where would you start? You'd pick up a set of accounts and you'd say, what is the statement of net worth as far as the accountants are concerned, all audited and signed off? It's called a balance sheet. All right. Now, for those people who are thinking, what on earth is a balance sheet? I would urge you strongly to look at my video, not surprisingly entitled, What is a Balance Sheet? Okay, that's a really good starting point for what I'm about to say, because in that balance sheet, you'll find an estimate using accounting rules of what the company is worth. So I'll call that net assets. And that might be, let's say, 100 million. Not a very big company. Let's say it's 100 million in sterling. Now you might say, well, there we go. That's what the company's worth. I mean, the balance sheet says 100 million net assets. That's signed off by auditors and so on. It's official documentation. So there we are. The company's worth 100 million. And if it had 100 million shares in issue, you could say each one's worth £1. 100 million over 100 million. Life isn't quite that simple. Why? Because balance sheets are a good starting point. After all, they're verified, by a set of auditors and blah, 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 blah. But there are problems with them. They don't represent what you'd actually pay to buy the company in the open market. Okay? Why not? Well, first of all, you need an up-to-date net asset statement. And if you just pick up a set of accounts, published the last time the company did its full set of accounts, you're probably several months out of date already. But even leaving that problem to one side, supposing you could get a balance sheet that's right up to the minute, you still wouldn't rely on it 100% as the basis of saying, well, that's what the company's worth. So I can look at the share price and judge whether I'm overpaying or underpaying. Or as a predator, I can judge whether I want to pay that price a bit more, a bit less, and so on. Okay. So why? Well, the answer is basically that balance sheets are sort of incomplete and they're prepared using accountants' rules. And that gives them 1 or 2 failings when it comes to really valuing the company in today's market terms. What are those? All right, well, you could have assets that are either missing from the balance sheet or assets that are in the balance sheet as part of this net asset 100 million, but are overstated. Okay, so you end up with asset adjustments, and they could be positive or negative. Right? What do I mean by that? Well, it may be that the company has written off certain assets completely, following the accounting rules that you think have some value as a predator. Okay, you think they actually have some value, so you'd have to tweak up the figure in the balance sheet to take account of that. All right, now, as someone buying a company, you want to pay as little as possible, but nonetheless in the back of your mind, you're thinking, well, those are worth something. Yeah, why don't they appear in the books? Okay, it could be old patents, licenses, that kind of thing. All right, and equally, you might want to knock some off. You might say, I'm knocking 5 million off that 100 million net asset figure because I think the stock figure in the balance sheet is overstated. There's no way it's going to be worth that much to me as a buyer. Or I think the receivables figure is optimistic. Okay, so there are little adjustments that as a predator you might start to make to get to a truer figure of what you think the company's worth. And by the way, you might enlist the help of accountants doing what's called due diligence in the sort of corporate finance department to help you with this exercise if it starts to sound a bit technical. Okay, so you're going to go through the assets, making adjustments. Another example where you may need to make a positive or negative adjustment is accountants often leave assets in the balance sheet at what's called historic cost, out of date. Land and buildings, for example. You might want to get some surveyors in to give you an up-to-date valuation and change the net asset figure accordingly. Okay. On the other side, there are liability adjustments. Just giving you a real flavour for this. Okay. Positive or negative. So what I'm saying is you'll end up with a revised number based on making those adjustments. Could be more than 100 million or less than 100 million. Liability adjustments could be what? Well, imagine you're buying a tobacco firm, for example. Okay? What sort of liabilities that may not have been fully captured on the balance sheet might you have to adjust for? Legal claims. Okay? Accountants have a habit of saying, well, you can't record a legal claim against those net assets unless it's reasonably certain, the impact's reasonably well known. Okay? But as a buyer, you'll be thinking, well, crikey, if I'm buying this thing and a load of legal claims suddenly hit me, I've got to cover them. That'll be my problem then. Okay? So you might make a downward adjustment by pumping in some more liabilities. Okay? There could be hidden nasties that are not reflected in that number that you're worried about as a buyer or even as an investor. Okay? Because these so-called contingent liabilities, to use the accountant's language, are a matter of some judgment. All right? So the point is this. Superficially, the assets approach to valuing companies is quite straightforward in the sense that you take a reasonably reliable starting figure, tweak it up or down, okay, according to what you think assets are worth or what you think the true liabilities position is, and arrive at a revised number. As a predator, you'll want that to be as low as possible. As the person selling this business, you always want it to be as high as possible. So then you get into a little bit of argy-bargy in negotiation, all right? But it's not as straightforward as I made it sound because, some of these adjustments, you need to have your wits about you. And that's where in practice, people who do buy and sell companies tend to bring experts in to help them in the form of, chartered accountants, working for corporate finance departments, investment banks, and so on. Okay? But that just gives you a flavour. And you don't even stop there. All right? Valuing companies is tough. It's not easy. There's no quick method. You get a number, say 120 million, and then you might think, well, is this the right approach for the business I'm buying or looking at? As an investor, what sorts of businesses would you apply an asset-based approach to? Well, there's a clue in the name, businesses with a lot of assets. What are those? Well, you could be looking at property investment companies, for example, investment trust companies. This sort of approach works better for those than it would for an internet or software firm where, frankly, there isn't much in the way of net assets to start with. Okay? So, net assets approach is one approach. Depending on the type of company, you'd almost certainly go on and look at multiples and look at DCF to give you the biggest range of possible valuations for the company to open your negotiations, or as an investor to give you some reassurance that the company is worth what other people seem to think it's worth. Okay, so there you have it, a fairly quick guide to 1 out of 3 ways of potentially arriving at the correct, inverted commas, value for a firm. Hope you enjoyed that video, and in future videos I'll take on a couple of these other areas for those people that have asked about them.